Everyone, welcome back to the channel. I'm here with Ray from TraderLion.com, and today we're going to be going through the chart of Roku, going all the way back to its IPO, as well as how it reacted in the 2018 and 2020 correction. And we're going to be looking for winning characteristics that you can use to find the next big winner. So, Ray, thanks so much for being back on the channel. And why don't you share your screen, and we'll start way back at Roku's IPO.
Okay, so in this video, we'll be going over a few concepts that are a little bit different than the prior videos we've done in this series. The first one that I want to point out up on the screen here is what I look for on IPO week and why I think the IPO week shows demand for a stock after it's publicly listed. So one of the things that I'm looking for on Roku is the fact that the volume in the IPO week in the first two trading sessions, which is September 28th, 2017 on Roku, had the IPO day volume, and the second day volume after the fact was higher than the IPO day. So what that tells me, even though there's no setup, no entry, no nothing on this chart at the moment, is the fact that there was demand for this IPO after it was listed. So institutions were looking to position in the stock just based on the fact that the volume on the second day was higher than the IPO day. This is one of the things, this is not a signal or an entry. It's just a characteristic that just sticks in my mind, and something that I would look for on IPO names to show me that such demand exists. One of the recent examples that we've seen with this is AI. Had the same, again, volume on IPO day, had a low closing range, but then the very next day, volume almost matched up with the IPO day volume. That's significant, telling you that there's demand from an institutional point of view. This 22.5 million in volume is institutions doing their research, and they feel that the stock in the very long run will do them well if they do position in stock. Rarely, if ever, you'll see retail traders creating such volume on the charts. One of the other examples I just remember before we move on is a recent issue in LDI. So this is not, your 10 million, 20 million, 30 million type of IPO, but the fact that the second day volume was bigger than the first, again, it's something that catches my eye, and this sort of stock will remain in my universe. If and when it shapes up, I will have this in the back of my mind.
So at this point, Roku would show up on your kind of IPO watch list. Is that right?
Right. So this is very early stage, back in 2017, it would show up. It doesn't really do much, right? And then this gap up, and I remember this really clearly, is their first earnings report on the stock, and the stock gapped up. I didn't know there were earnings, and I had a starter position because it started tightening up coming into the volume area. So I sort of got lucky with the fact that it ended up moving up. So don't be doing that. Know your earnings dates, but the fact that, volume comes in again right through, some folks take the highest close. That's something that I do. Others take the very high, right? If you follow the textbook approach, you take the very high, which is 29.80 as a spot. But this sort of volume, again, the highest, if you compare any of the other updates, it's the highest with the earnings catalyst. That's pretty positive with a high closing range. So again, I would set my alert somewhere over here. It would tell me, and the fact that I was already in the stock one day before the earnings was just pure luck, and not knowing the earnings date properly. Once it moves up, so the second thing that I want to cover in this video is the fact that we tend to forget what good, risk management looks like in the markets, because we want to play at the pace of the market and not at the pace that we are accustomed to, or our system is built around, right? Many of us just want to, if we're going, you can only go as long as the stocks move in your way to make you feel good about the system you have in place. As soon as it goes haywire, you start blaming everyone but yourself, but you should be blaming yourself if you're trading this sort of action that's outside the risk appetite that you currently have in the market. So a 27% swing up and down, there is no place unless you're, from an institutional point of view, if you've been accumulating stock, that's a different story. For a retail trader, maybe this is an entry point given the fact that the volume was high, right? But to be positioning in a name that's exhibiting 30% ranges up and down, that if that is not within your system, you should not be doing that, regardless of if Roku goes to $100 right here or 200, doesn't matter whatsoever. So know what fits your system. 30% ranges, I could tell you right off the bat, does not fit many risk appetites. That's more so let the institutions work themselves out and what direction they want to take in the stock. The only entry within this, your very young stock, the closer you get to IPO, they tend to act like this a lot, is this area maybe, it starts tightening up, but then it breaks out right away. And we see a pretty good breakout failure right away on the stock. If you positioned in from this area, it will kick you out pretty much in a week or two. So this action over here is you should not be trading this action. This is not for many of the traders that are starting out, or any trader for that matter of fact. When we're in the moment, we like to feel like we can play at the pace of the markets, but that usually does not end well for many. And given that we're recording this on March 6th, 2021, we're still in the midst of a correction, right? And many of us did try to play at the pace of the markets, and we got pretty well burnt. And now we're looking for answers of why. And the answer is you shouldn't be involved in this sort of action in the first place. That's the answer. Second concept. So after this IPO concept and the IPO week, the volume being high and all that good stuff, is the fact that you want to learn the behavior of the stock and what it's doing. What are the habits that it has? One of the habits that Roku tends to have is these, 10, 20, 30 day, multiple weeks of declines and just pure red on the charts where no KMA matters. There's no respect for anything, right? And it just tends to decline. And as I scroll to the right on this chart, you'll see that it tends to do that very often. So this is emotional action on the charts with 30% price ranges. So if you want to get involved in that, make sure you have a plan. And for most, I just say don't do anything here.
Right.
If this just goes, let it go. Who cares? This is really the first spot that I see, after this recovery, you see how the KMAs are bunching up and the volume is drying up, right? We forget that eventually all stocks will exhibit such characteristics, which is the point of this series, is to point out the characteristics you should look for again and again. We forget that this will happen eventually on all winning stocks when we're trying to trade this mess over here. It's just how psychology, how we work, how we function, because we want to make money every day, which is not possible in the markets. And when it does this, I mean, this is from a swing trading point of view or price action volume point of view. This is still fairly a non-traditional entry. If you've been in the markets for a long time, when you see the KMAs bunch up, your eyes light up. But this is sort of, could be that first area where you see a volume dry up and maybe you position in the stock. Not a must. Again, the first area that I really see is the fact that it gaps up here and then it really tightens up. The stock is really tightening up. Now institutions are in control of the stock completely. So narrow ranges show that multiple parties in the market are interested in positioning in a stock. When that happens, we get narrow ranges, which increases liquidity. Liquidity means price at each level is seeing a lot of shares per level that it's trading at. That's when liquidity is high, there's certainty in the markets. When liquidity is low, right? Liquidity is low, price ranges widen. So this is low liquidity. Price is just going, it's acting emotional. again, this decline, if you see, the volume is not that high, but the fact that, there are multiple parties that aren't interested in the fact that the market's under turbulence. The market's under turbulence. The market's off highs. This gray area, this is market's off highs. And we're just zigzagging back and forth, and nobody at each price level, there's not enough interest, therefore low liquidity, and the price just trickles down. When we see this action, this is liquidity returning to this particular stock. Maybe something has changed, stories changed, analysts upgrade, someone's accumulating stock, something, right? The reasons are endless, but the only reason that you really need is the fact that you could now define your risk, right? As soon as you could define your risk, you could position it in a stock. And that's really all that matters from a price action volume trading point of view. So if we want to position, we can have tight defined risk. Maybe it burns you a couple of times, but you have this blue wall behind you to sort of guide you, and then it works for a little bit. If position from here, this is about 60 to 77. Don't really know the percentage, but less than 50%, right?
Right.
Gain. One of the rules that I have is 2 closes below the 21 DMA or the 23 EMA, and the stock will kick me out. If it kicks you out, again, stocks go through these cycles. So price is going to get emotional as it gets below the 50 DMA, right? Price gets below the 50 DMA, ranges increase, right? And we'll continue to see that. So now 2 things happen here. If at this point Roku is considered a leader, so remember, we're back in time, we're somewhere in 2018 right now. If this was considered a leader in its space and a leader is breaking down, and the market, this gray, these gray lines, they're the market. So market's under pressure, leader's under pressure, your sell rule triggers over here if you position from here, right? Now you're out of the stock. Let the stock do what it needs to do that actually made you money in the past. This action made you money in the past. Buying the stock here below its KMAs, 65 is your orange line, 50 is your black, the black is your 50-day. This is all in motion now. And there's no reason for you as a retail trader or a price action volume trader to be, attempting to buy it here or attempting to buy it here or attempting to buy it here. The market's under pressure too. That's one. Second fact is it's below its 50 DMA and 65 EMA. There's nothing on this chart that says that you need to be playing hero ball trying to build a base. Let the institutions come in. When institutions come in, it will look like this again.
Right.
So I'll continue scrolling to the right, and we'll see institutions come back in. And I'm not making this up. This is historical data. So again, one of the things that we talked about, right, it has a tendency to do this, this trickle effect, where this is the second time it's doing this, right? It just has a tendency to, first time we learned that back in 2018, if you guys could go back in the video, but it has a tendency to do that, and it did that again, right? So learning the behavior of the stock and its history, what's to the left side, is also very important. So if we keep scrolling to the right now, and now at this point, the market's been in correction. This is, if you've been around for a while, it's not even that far back, but market's in a correction, right? We're off highs. We see big ranges. When indexes have 3 to 4% ranges, that means liquidity is low. Indexes are made up of stocks, right? Stocks, when they move like crazy, indexes like the S&P 500 and the NASDAQ will move like crazy. When the indexes are moving 3 to 4% up and down, that shows you that the stocks are also acting crazy. Everything's crazy. Nothing screams certainty. There's uncertain, the environment gets uncertain, news matters, everything, someone saying something on TV will drive price down because institutions have stepped away, they've stepped back in a way, and liquidity is, even though they might be accumulating stock on the down while it's moving down, it's not an environment from a retail point of view that's a good one to be trading in.
Right.
So again, market pressure is starting to lift at this point. And what happens is these ranges that we see, so this is like single day minus probably 10 to 15% haircut, right? This is just, I don't know what the heck this is. It's just getting slapped lower again and again and again. Your job is to keep away from stocks that do anything below nothing good happens below 50 EMA and 65 EMA. And this is a pretty good example. This is $60. This is $26. That's a pretty good haircut on that. So market pressure starts to lift. That's at this point, we would have probably been on a follow through day watch, right? Given that we just came through a correction and the stock gaps up. And I remember this day fairly clearly. It gaps up. And what happens from that point as certainty returns to the market and we start resuming an uptrend, price action starts to get tight. Now, this sort of action, again, is sort of similar to this sort of action, right? Certainty is returning, liquidity is returning, institutions are once again in control, and they could really control stock, and that's starting to show. That's not to say that they weren't accumulating on this. That's their job. Their job description is very different than what our job description is in the markets. So we see certainty come back, uptrend resumes, and we start, it's a little too far. And we start to see tighter ranges. And again, we can somewhat define risk on this name, given that we have this sort of volume behind us, right? Now, is this the ideal entry for every single trader, given the fact that we're still right near, below the 200-day and just reclaiming our 50 days? Not every trader is going to be, okay with that. But the fact that we've had about 90 million shares or 80 million shares being traded, and then the character of the stock, if we compare the emotion here versus the non-emotion here,
right,
with the market in an uptrend, again, we start stacking evidence that, a trend might be coming and the stock might have, a good probability of moving up now rather than doing this again.
Right.
So if we keep scrolling to the right, so it sort of trends out of that. And then, there's where we were at this point, market resumes an uptrend. The stock, you could define your risk here. Stock moves up. I believe this might have been an earnings day, right? And then, we're sort of in that trend at that moment. Now, depending on your rules and depending on your cushion, something from 30 to $40 to $75 doesn't break any KMAs, sort of, it's a good trend. And then you feel portfolio pressure, 2 closes below the 65 EMA, though it doesn't do that here because there's one, it does. So depending on your rules at this point, this is, you're managing the position after you manage your risk. Step one is managing your risk, positioning in a name. Once you have progress, then you have profit taking rules and sell rules. Whatever it is, this is a much better environment than this environment that we see on the left. So we keep going. I mean, the stocks do this again and again and again, and I think we could go to 2029. Now, again, we see that tendency come back. This is the third time the stock itself is exhibiting this sort of action, right? Where it just dies out completely when we're saying from the 160 area to the 58 area. So Roku, in and of itself, has a tendency to do that. One of the other things that you want to notice, so now we're, somewhere 2020, That's our most recent correction, the big one. So even though the markets are trending at this point, the stock started to weaken way earlier than this happened, right? So at that point, your sell rules, when they say something is not right and they're pushing you out, you have to get it out. I mean, I don't really see a more recent area, maybe this area after this volume, right? You could define your risk. You do a little bit of that and you probably get kicked out at this point. And then it just starts acting crazy. This is
That's a
not
change in
retail piling.
character.
Yeah, there's a clear change in character. And also this is not retail piling out of stock. These red bars, there's just some institution, someone just says enough's enough. I want to
Right.
move on. Pressure lifts, it does a natural rise as the pressure, whoever, something was selling or some institution was selling out of stock, whatever the case might be. Pressure lifts, and then it starts to just, you see the RS line completely decline, even though the market's in a trend. At this point, this leader, if it was a leader, right, becomes a laggard.
Mm-hmm.
And if from a price action volume point of view, relative strength point of view, you're basically out because of this. This is just kicking you out below KMAs and just drops and does nothing. So now, if we go over the most recent correction, again, we will see the same stuff repeat itself. So at this point, April 6th, we get our follow through day. So one of the first things is Roku would not be high on my list, given the fact that the stock is not anywhere near its highs at this point. So if we have our follow through day, which is this candle, right? April 6th on the NASDAQ, I believe. This is still near its 21 day, which is below the 200, below the 50, and it's just still working out what it wants to do next, right? There's no tradable range here, given the fact that we're still going from $100 to $80, and we went from $60 to $100. Range is still fairly wide on the stock. So institutions are not yet stepping in, but when we keep going to the right, we will see them. We will see ranges sort of tighten up as certainty returns to the market. So one of the first spots. Now, depending on your style, I don't tend to trade this sort of action. It's still not tight enough for me, even though we're in an uptrend, right?
Mm-hmm.
Maybe you have a different style, investing style, whatever the case might be, and you start accumulating stock because the market's in an uptrend. That's a different story. But for me, I like to keep my risk less than 5% when I enter into a stock. So this is still for me to a little bit, it needs to do more work or it needs to do more to convince me to position in the stock again. The first area that I see, we see this happen and we see this happen. 2 blue bars on high volume, above average volume. Think of it like a blue wall. And then we see consolidation in the stock itself.
Mm-hmm.
And this, again, this sort of action feels natural to me as a trader, right? What I call this is institutions are controlling the stock fairly tightly now, given the fact that we have a dry up in volume when the price is consolidating, and we're holding the volume support as price retraces. So this 142.15, 146.15, this is support. So this action is much better to define risk. Again, the first question you want to be asking yourself is, what's my risk? It's much easier to define risk over here versus this thing, right? At least for me. So if we keep scrolling to the right, we will see another entry area.
And it gets tight again right after the area you pointed out. It also gets tight just very soon after that, once again on very low relative volume.
Right. So we get knocked down a little bit, whatever the case might be. Again,
you might get stopped out there, but you can always restart your position.
Yeah. Exactly. So again, this volume is much bigger, and then the price comes right back to this area. It holds, right? Some traders. So I know I tried to position in this multiple times in this area, and I ran out of patience, and then we just get, it just takes off on bigger volume. I believe this was an analyst upgrade or whatever the case might be. So again, these are definable. You could define your risk in these areas or this area, right? Now, the fact that it's consolidating on low volume does not guarantee that the direction on the stock will always be up. It could easily be, it could easily be breaking the 50 or the 65. But the point in the market is as soon as you could define your risk, your exit points, right? So if this stock hits you and you may lose 2 to 3% if you go versus the 50-day over here. That's fine. I mean, that's, you defined your risk. You had retracement on low relative volume. You had volume behind you, and you just say that it's a system loss and you move on, right? System losses happen. No trader is going to say there's no 100% win rate. You could do really well with a 40% win rate in the market. So that's an area that I see that makes sense from a price volume point of view versus this is a little bit more emotional. It's just coming out and it's sort of not high on my list. And it wasn't high on my list right near the follow through day, right? And then given that 2020, the way 2020 is gone, it's just amazing, right? So if you position from this area or you're positioned from this area, or if you position from this area, you get kicked out, but then you got to buy it back right over here because the volume's really high, right?
Mhm.
One of the things is market's pulling back. Again, market's pulling back and it's showing RS days.
Right.
So this is gray. The market is pulling back and Roku should be on your RS list at this point, right? 1, 2, 3, 4 days over here. It should have bugged you and said, it's holding the 50 DMA. It's holding the 50 DMA. It's holding the 50 DMA. If you really didn't get any of this, it would have bugged you in this area with RS days. And then even on this area, right? If you bought here, maybe you got kicked out, but then you got to buy it back.
Right.
So one of the hardest things to do in trading is to buy back a stock that didn't make you money. From a psychological point of view, that's really hard to do. And it takes years and years of, self-talk and convincing that even though it didn't make me any money on my last trade, last 2 trades, the last 3 trades, if it still exhibits really good price volume characteristics and dry ups, and I could define my risk, you just have to buy it back. That's just how it goes, right? No, there's no real way to know this one's gonna stick because it didn't. It came right back. There's no way to know that this one's gonna stick. It didn't. Came right back. But the fact that from a PV point of view, from a risk point of view, from knowing the story of the stock point of view, all that adds up, and you keep trying to a point where at some point it will stick, and maybe you could get a winner, right?
Right.
So buying back a loser is one of the hardest things to do, and that's something that traders should work on again and again and again. So from Roku's point of view, we continue. So given the fact that we see these intermediate corrections or retracements on markets that cause pressure, Roku had RS days and then it trends again, right? In this area, again, this was market pressure. Roku sees market pressure. If you're positioned from 143 or 150s, maybe your rules allow you to hold, again, the volume on the retracement. If we point that out,
There's nothing there.
There's no volume. It's just the fact that it's retracing is because the market's under pressure, right? And then you have to go back when you review your positions. If you're positioned from this point, maybe you got some stock at this point. You just have to have the discipline in you if you want to be in such a big winner in the markets to say that this is, I'll give it the benefit of doubt. I have rules in place that at best, breaks the 50-day and the 65, and maybe you make a little bit of money on it at that point when your sell rules trigger, right? But the fact that market's under pressure, it's retracing on low relative volume, that's added evidence that you need to exercise some sort of patience so that you can be in a winner in an uptrending market that just, the stock just kept going. Now we were just talking about 140s, 150s. Now it's at 400, right? And then, so when you're reviewing such stocks and what they do, your sell rules that you build should not be based on just a Roku. They should be based on your past trades plus you studying past winners in the market and seeing how can a stock keep me in this move. And that's how you make rules. Rules just don't, rules have to fit your personality. For some people, they don't want to give back a large gain, say from this point to this point, but then it's you have to answer the question that, do you want to be in this if it happens versus, trying to pick a top here and saying, yeah, if it breaks 21 DMA and I have a cushion of greater than, 70 or 50, 70%, 50%, 100%, I just want to sell because it broke the 21 DMA. So rules stem from the fact that you've studied your own past, you know your own personality, and you've studied past winners in the market that will allow you to be in such moves. So all those things are the basis of your, the rules that you have or the rules that you play the game by in the markets. So again, this is pretty textbook stuff. You won't see this every single year. This is a 2020, it was a paradise for such stuff. Price retraces, volume goes low, price increases, volume comes up, right?
Mm-hmm.
And we just see that all the way as the stock holds its 50, 65 EMAs all the way up.
Yeah. And looking at the recent times, it really showed a change in character, because after holding the 50 and 65 pretty much during this entire uptrend, now just recently it's finally broken through those key levels, if we can see there on the right side of the chart.
Right. So again, this sort of movement where we go from 150 to $500 does not happen every year. On many stocks, it's the fact that 2020 is just was a different type of year, and things lined up in a way where we came out of a market that corrected 35% from the top, and that sort of rush, given the, everything sort of lined up with the environment, Fed rates and all that stuff, everything lined up, and we see this action. This should not be expectation. That
Right.
2021, you'll find 10 of these, you can't and you won't. So over here, we see a rise in volume. If you just count from this point on, count the pink days on above average volume. By pink, I mean down days, and you count the blue days, right? So there's a change in character, which is reflected by some sort of market pressure. And we know, since we're March 6th today, this is pretty fresh in our minds, is that growth was under pressure.
Right.
Stocks just, they started acting weirdly. Things that were working stopped working. So in such environments, if you're trying to position over here off the 50-day, if it kicks you out, it kicks you out. Don't, if you tried to position here, you just take your loss and move on. One of the sell rules that I have is 2 closes below the 50-day or the 65 EMA, depending on the cushion that I have. So if the cushion that I have is greater than 100%, which would mean I'm positioned over here, maybe positioned in this area, that's still a double.
Mm-hmm.
So depending on where you're positioned at, one of the rules that I have, if I see 2 closes below the 65 EMA or the 50 DMA, depending on portfolio pressure and all those things, I will cut stock and move on. That's just how I approach it. Again, your rules are dictated by you and how, what your risk appetite is. But for me to see if I'm positioned from these areas, to see a stock from 500 to 300 is a little bit too much for me personally. So this is just a rule that I have. If I see this, I have to sell the stock. It just, there's nothing. I'm not looking for some sort of story to support my thesis at this point to make me feel good. There's nothing good about this. It's just, these are the rules that made me money in the past. These are the rules that will make me or allow me to keep the money that I made in this stock again and again and again. Again, your rules should be time tested, not based on a single stock. Should be based on your risk appetite. Should be based on your personality. Should be based on what winning stocks do. And when they stop doing that, you have no right to be saying that I'll hold and see what happens. If it just does this again, maybe, the habits that it has, it went from 160 to $60. It went from, that $28 mark from the $68 mark to 28. Now it's doing 486 to 300, maybe, who knows, 200, right? At that point, you don't want to be hoping. Given the nature of the stock, just have sell rules, move on. You made money. There's no need to, read an article on, I don't want to name a news source, but
you don't want to go out looking for news that supports your thesis. You want to follow the price action and let technicals take you out, not even considering the fundamentals.
Exactly. You said it much better than I could have.
Awesome, Ray. Is there any other main points that you wanted to cover when it comes to Roku?
Yeah, I mean, so we could do a quick summary.
Yeah.
You have to know what makes you money in the markets, which is non-emotional, rational price action. So when things get tight and you could define your risk, liquidity, returns, market. So the M is important.
Right.
So M in can slim is important, right? Without it, it doesn't matter what stock, what story, what price, holding up well, holding up well, trying to be a lone warrior. It's not going to work if the market's caving in and the growth space is caving in, it's going to follow it no matter what. Doesn't matter. 3, always ask yourself what, from a risk point of view, can I define my risk? Can I define my risk? You can't define your risk in this area, right? So what's my risk would be the third takeaway. And the fourth is have rules. So fourth is rules. So make sure you have rules that kick you out of a position. The story will remain the same. Roku didn't stop selling their devices that caused this drop. It's just the market's under pressure and now we don't know what it's going to lead to. Maybe it does this, right? Or it just recovers here. Who knows? Whenever price shapes up again, from a price action volume trading point of view and the cushion or the average price that you have, you can always get back in the stock. If it comes up, it does a sideways thing, volume tapers off, institutions come back, market resumes an uptrend. The whole recipe, it's the same thing, different stock. Right. But our psyches don't allow us to do that many times. So these things, have them in mind. It happens again and again. I guess one of the questions, one of the last comments would be, there's a lot of doubt that traders have that, what's going to happen now? Growth is not working. Everything in the growth space, will it ever work again? Yes, it will. You just have to go back, study the market, study your past trades, build your own confidence in the market. The environment will return. Many of us that have been here for a decade, 2 decades, 3 decades, we see this as a corrective state. Things will, do what they need to do. And when the environment's favorable, we'll get back in. There's no such thing as, will this ever happen again? Or canceling just stop working? There's no such thing like that. Canceling's been here since older than me. So it works.
Absolutely. Absolutely. All right, guys, I think that's a great place to end this video. If you did enjoy this episode of Winning Characteristics, go ahead and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos.